So for those that don't know, and obviously the audience is small, but this will be on the recording that we'll upload to YouTube after this. But Blockware Solutions is a Bitcoin mining company. It's one of the largest ASIC brokerages in the world, and we have Bitcoin mining facilities in Kentucky in the U.S. So if you're ever looking to buy ASICs, you're looking to sell ASICs, we're the place to do it. Blockware Intelligence is the media and research arm of Blockware Solutions, where we have a weekly newsletter, we have a weekly podcast, and we've interviewed people like Michael Saylor, Lynn Alden, um, executives of publicly traded Bitcoin miners. So definitely check out the podcast if you haven't already. But with that, we can go ahead and probably kick it off. I know Blake can maybe start us off with what he's seeing in the macro world.
Yeah, definitely. This will be a pretty short macro section this week. Normally, I ramble on in this space for a good 20 minutes about it, but it was kind of a quieter week. Last week was fairly crazy. This week there wasn't too many economic data releases or anything too major. So price action was a little wonky, but from a macro perspective, there isn't a ton to update. This week we did get the release of February's PMI. That's the Purchasing Managers Index. PMI isn't, I wouldn't say it's necessarily like a huge market mover, and it's more so just an indicator of economic health. It's a really strong indication of where we are in the 2 to 5 year business cycle or short term debt cycle, if you will. But essentially, what it does is it's put together by ISM, the Institute of Supply Management, and they essentially are sending out a survey to purchasing managers, and here we're talking about manufacturing managers specifically, but they're basically just asking them a question on, what's your outlook on the industry? Do you think conditions are expanding? Do you think conditions are contracting, or do you think things are stagnant? So then from there, they're able to compile an index that kind of gives you the confidence level of manufacturing managers, and historically has been an extremely accurate indication of where we are in the current cycle. So for February, the number came in at 47.7%, which means that the majority of managers interviewed are seeing a contraction in economic activity in their sector. So generally 50% is kind of the benchmark used. So if the PMI comes in above 50%, you could say that we're still in a economic expansion. And then when PMI comes in below 50%, you would say that economic conditions are contracting. So as I mentioned, it was 47.7%, which is now the fourth straight month of contraction, or fourth straight month of the PMI under 50%. That being said, PMI has been coming down since I want to say 2021 or so. So it's just kind of I think it's just kind of a function of liquidity in the market. Obviously, with rising interest rates and in this Fed regime, you're going to have a contraction in liquidity, which generally leads to a decline in PMIs. So currently, it's saying that we're in this contractionary cycle or contractionary phase of the business cycle. That doesn't necessarily mean that we're in a recession. Obviously, there's a lot that goes into the recession discussion, but it's certainly showing from a manufacturing perspective there's a contraction underway. So that was kind of like the main update from the macro perspective. This year or this week, we've kind of seen a continuation of what this newsletter has been talking about for several weeks now, and we even wrote about it in our 2023 market outlook that we wrote in November and put out early December. So it's pretty interesting stuff. But what we're seeing is that it's kind of this idea of rates are going higher for longer, right? And it isn't overly surprising. I think a lot of people predicted this. But what we're seeing this week is treasuries continuing to sell off. The 2-year treasury yield hit a new cycle high above 4.881%. Yesterday it hit 4.944%. So that's just kind of the market pricing in higher rates. We talked about this last week. The 2-year is the most policy sensitive treasury. So essentially, during these types of markets, the peak of the 2 years yield is kind of a good proxy for the terminal Fed funds rate. So it's whatever the 2-year yield peaks at is roughly what the market is expecting the Fed funds rate to hit in the future during this current hike cycle. So obviously yields peaked in November, and now they're starting to make new highs again, which is just a function of the market pricing in higher rates, like I mentioned. So with that, what's actually interesting is generally when you have rates rising, you're going to have a sell-off in stocks as well, because the discount rate is rising and it lowers the present value or valuations of stocks. But what we're seeing is we're actually seeing some fairly decent strength here yesterday and today. Yesterday there's a pretty big gap down, down close to like the 50-day on the Nasdaq, but ultimately reversed higher and closed green on the day. And then today we're kind of seeing a continuation of that strength. It's really impressive to see and honestly pretty surprising. But from there, I think the market's just kind of waiting on economic data. Next Friday or a week from today, is the jobs report for February. So that's generally a pretty big market mover. So that's just something to keep in mind. But we should be able to, with the timing, get a discussion of that in next week's newsletter. Do you guys have any questions, comments there? Or do you want me to move on to crypto exposed equities?
I think that was great. I do have one quick question, Blake, and it's kind of just taking a step back and looking at all of what's going on in the macro world from like a very big picture. Why is it like, so this is like, obviously, we talk about Bitcoin a lot here and for good reason, I guess. What's the point? Like, why look at bond yields? Like, how is that important when you think about, bond yields, macro, and Bitcoin?
Yeah, that's a really good question. And I think yields have a lot of effect on the market, and yields are kind of a function of the smart money, and I'm air quoting smart money, kind of their expectations on the future of the economy, if you will. So rates are, or I should say, yields are a function of interest rates, and markets are forward looking slightly. So we're kind of it helps you get an expectation of what's to come for the market, or at least what the market currently believes is going to come. From the equity perspective, the stock market perspective, yields are very important. As I mentioned, and I won't bore you with all the finance tradfi stuff, but essentially the bond yields are used as a discount rate to valuate stocks. So if you want to know what you think a stock is worth, you have to discount that. So essentially what you're doing is you're looking at what other opportunities are there to invest in. So when yields are rising, that the present value of stocks are going to fall, which leads to sell-offs in the market. So from that perspective, yields have a relationship with stock valuations, and they have a relationship with stock price. Therefore, and from the Bitcoin perspective, then the equity indexes and Bitcoin price action have historically had a fairly close correlation, and now in recent months it's started to decline. And Mitch talked about this last week with the correlation coefficient between I want to say it was the Nasdaq and Bitcoin flipping negative. But generally speaking, they're both treated as risk assets, or I should say, Bitcoin is treated as a risk asset. Stocks are risk assets. Now, whether you believe Bitcoin will continue to be treated as a risk asset is a very different discussion. But for the time being, if you're going to see a huge sell off in stocks, Bitcoin is going to get taken under with it. I mean, that's just kind of the fact of the matter. That was a long-winded answer. I hope it answered your question.
Yeah, thanks, Blake. That was good.
That was a really nice quote, Blake. You're gonna have to tweet that later, or I'm gonna steal it. When you said Bitcoin is treated like a risk asset, stocks are risk assets. I really like that.
Yeah, no, that was good. But yeah, so from there in the newsletter, I kind of got into the crypto exposed equities a little bit. There wasn't a ton from price structure perspective. These names have kind of just been floating downward, sideways for the last few weeks. With Bitcoin breaking down today, it's some of the names are following suit, some of the names are up today, so it's kind of a mixed bag there. From the fundamental side, a lot of public miners released their production updates for February this week. Mawson, just announced that they're expanding their facility to 120 megawatts. CleanSpark hit a new peak efficiency, and they're waiting for more power to come online and to take delivery of those 20,000 Pro Pluses. Cypher brought some more hash online. Just generally speaking, I think it's pretty interesting to see that when you get down to the depths of the bear markets, you're going to have miners just absolutely pouncing on the opportunity to build out infrastructure and buy cheap rigs and things like that. And I think it makes it really hard not to be bullish on Bitcoin, and at the very least mining in the long term. And you just see this relentless expansion underway. Just the sharks are pouncing on the blood in the water. I think is really interesting. Also, I mentioned, kind of the Silvergate stuff that's going on this week. If you're not aware, Coinbase, cut their ties with Silvergate to be their banking partner. Coinbase wasn't alone. There was, Galaxy Digital, Gemini, Bitstamp, Circle, Paxos, a bunch of other people did the same thing, and it's kind of been, a function of what's going on for the last several months. There's been a lot of concerns about Silvergate's liquidity, about their solvency. So I think the market moving away from Silvergate is probably a cause for concern. Silvergate was down whatever that was, 50+%. Was that yesterday? But Silvergate's down 70% year to date. It's down 98% from that all-time high. So it's just, I thought it was interesting and worth noting in the newsletter. Silvergate also pushed back their earnings release. They were supposed to release. They had a deadline of March 16th to release their 2022 report, and they of course were not able to, or are not going to be able to do it. That they announced that yesterday. So it just seems kind of all but confirmed that the liquidity is a serious issue over there. Do you guys have any thoughts, comments there?
You mentioned in the newsletter that Silvergate's the second most shorted stock in the entire market. I'm curious. Do you know what number one is?
Yeah, I couldn't tell you what they do. But it's nothing crypto related. But I want to say Silvergate was the number one shorted stock in the market, and then now this week with price down so much, you're probably going to see a lot of that short interest drying up. But Silvergate for a long time has been top of the list of most shorted stocks, and I was kind of curious to see. Obviously, when you have a really high short interest like that, there's a huge opportunity for a short squeeze, and you can have this cataclysmic upside move if all those shorts are going to get wiped out. So part of me was like kind of waiting for that, just personally, just keeping an eye on it. But of course, the shorts have been extremely profitable here.
Yeah, Blake, this
Cool.
real quick, and then Mitch, you ask your question. Is this basically like a roundabout like bank run on Silvergate? Like I imagine like most large banks may have, and I don't know, maybe I'm talking out of my league here, but most large banks probably have like a ton of different clients where they're all holding maybe small amounts like under FDIC insurance, whereas Silvergate may have a bunch of large clients that are like Bitcoin and crypto related that have deposits well north of the, I guess, FDIC insurance for one account. And so is this kind of like an actual bank run on Silvergate? Because if they go under, there may not be a bailout obviously for depositors, or am I just completely wrong there?
No, I think you're spot on. It is kind of exactly what you talked about. There is a risk there involved when you don't have the diversification, Jesus, of what a traditional bank might have, right? So when all of your clients basically are in one industry group, and then you get severe market contagion like we got in 2022, it creates the risk of a bank run occurring. And based off the news this week, it appears that's pretty much exactly what we're seeing is all their big clients are flocking to pull all their money out.
It seems like Bitcoin's held up surprisingly well considering all of this going on.
Yeah, I was just about to talk about that. The bid strength in Bitcoin has been, I would say, very impressive in recent weeks, and it's similar to what we were just talking about with the correlation between the equity indexes and Bitcoin. And what we've seen over the last few weeks is the equity indexes are selling off, but Bitcoin was just kind of moving sideways for the most part, which I found very impressive. That being said, last night, so the newsletter gets released Friday midday, but I normally write it Thursday night for the most part. And last night, I kind of had it written down that this looks like a bear flag to me. There's pretty high risk of downside prices in the short term. And then when I got up this morning, it already happened, so I had to rewrite the whole section. But yeah, I mean, the bulls have been pretty strong of recent, and price now breaking down through that lower trend line and down below the 50 days, obviously not a good thing. And obviously, we're looking for a reversal, on that daily candle, but I would just say, there's a lot of risk in the market right now, and Mitch is going to talk about the on-chain stuff, and there's a ton of promising, metrics to look at that, make it look like Bitcoin is, maybe towards the end of this bear cycle, or there's higher prices to come. And I think it's, obviously very possible. I just think the macro risk is so big right now that, a lot of funds are going to be, scared to jump back in when, who knows what the Fed's going to do, or who knows what's going to happen with all the other, inflation metrics and things like that.
That's a good point, Blake. It definitely the funds are weary right now. It's definitely the plebs that are putting enough buy pressure to keep Bitcoin up where it is. With that, we can go into on chain unless you've got any more comments you want to make.
No, go for it.
Cool. So typically I mostly talk about on chain metrics and do a little bit of derivatives at the end. But this week it was different because the price move last night was primarily a liquidation cascade. That was the main driver. So you saw open interest drop by almost $1 billion worth last night. And then when you look at the total futures long liquidations, it was the biggest spike since August of 2022. And when you look at this chart, you see one giant candle, whereas around the FTX capitulation and the Celsius capitulation, it's more of a cluster, and that was because it was a capitulation, not like obviously the price going down caused longs to get liquidated, but that wasn't the main driver. Whereas the price going down 5% last night, if you look at the hourly candle, it's pretty much just one giant red candle. It's not consecutive red candles over the course of the day. So it was definitely longs being liquidated there, which we said this last week, and we say pretty much every week. You really should. Using leverage with Bitcoin is just going to get you wrecked, because you can be right directionally, but this asset is so volatile, as we all know, and it's likely only going to get more volatile as we sort of change monetary regimes, which is our thesis, right? That we're going to go to a sound money standard. So the volatility is only going to ramp up as we get closer to that happening. But despite this price going down 5% last night, we still have all of the year to date gains in price pretty much for Bitcoin, right? We started the year around 16,000. We're still up well over 20,000. So definitely the bigger picture on chain hasn't changed. The first chart we looked at in the newsletter, which is something we look at frequently, is the realized price metrics. And short-term holder realized price is finally past the aggregate realized price for the market. So now short-term holders have on average a higher cost basis than the rest of the market, and that typically signals the end of the bear market, based on the past few bear markets in 2018 and 2015. So that crossover happened recently, which is something we've been looking for. Definitely an optimistic and bullish sign. Another thing on the long liquidations is, if you look at, there's a liquidity map we've put in the newsletter. There's still a huge wall of shorts at 25,300. So that's definitely like the resistance level at the moment. If we hit that, I mean, we're probably gonna get some sort of a short squeeze, possibly all the way up to 30K. So I tweeted this last night, but basically any movement between 20 and 25K is pretty much noise at this point. We've cleared out all of the margin calls for longs and shorts in that range pretty much. Longs don't start getting liquidated until around 21,000. So we're good for now. That price drop last night should be it for at least the short term. I would expect over the next week or so, probably until that data point on Friday that Blake was talking about, we probably just move sideways. And something that's somewhat bullish is the funding rate flipped negative last night. So the last 3 times we've had a negative funding regime, the Bears ended up getting wrecked. So definitely going to keep an eye out on that. What you don't want to see, especially during those liquidation cascade events, is funding going more positive as people are getting liquidated, right? Because that's just showing the markets wanting to jump back into more longs while the longs are still being liquidated. So seeing funding go negative is definitely a sign that, hey, like, the market is afraid now, and it's cooling off. You're going to have to pay to go short now. we'll see how long this negative funding lasts. Typically, negative funding doesn't really last very long in Bitcoin because there's this inherent bull bias. Because, as everyone knows, Bitcoin goes up in the long run. Even if you're bearish in the short term, everyone inherently knows that, hey, there's only 21 million of these demands going up. In the long run, Bitcoin, the price is pretty much has to go up. And another chart we put in the newsletter is the percent of supply last active one or more years ago. And again, the long-term thesis has not changed here. And the price is set on the margin, right? So, anything can still happen in the short term. But when you see a large amount of the supply just become inelastic and get in the hands of these long-term holders, it typically tends to precede the price going up. So definitely something to keep an eye on. And as long as we continue to trek sideways, which is my base case for pretty much all of 2023 is relatively sideways price action with some volatility, then long-term holders are just going to keep accumulating more of the supply, right? As I mentioned at the beginning of this section, the plebs are not going to stop buying. So even if the institutions aren't jumping in, the long-term holders are going to keep accumulating, especially if the price is going sideways or down. So the more they accumulate, when the bull run inevitably comes and institutions step back in, lots of demand steps back in from speculators, then having a huge percentage of the supply being relatively inelastic in the hands of long-term holders is going to make the bull run melt faces even more so. And the last chart I put in the newsletter shows the percent change in price relative to the percent change in difficulty. And this is something Joe definitely will probably want to speak on as well. But what you sort of see, at least how I view the Bitcoin market, is that price leads difficulty. So when you get these massive bull runs, mining becomes extremely profitable, and you're going to see more people invest into mining infrastructure and rigs. But that's real world effort right there. So you're not going to see that difficulty show up on the network for about 6 to 18 months after the price goes up. And so we go through sort of these different regimes where a price might be growing at a faster rate than difficulty, or difficulty is growing at a faster rate than price. And recently we just entered a regime where price is now growing faster than difficulty. And we did see some minor capitulations in 2022. We saw one towards the end, and that definitely contributes to the slowing difficulty growth rate, as well as some other stuff we've mentioned in past spaces and past newsletters about the commoditization of ASICs. But we have entered a regime where price is growing at a faster rate, and this sort of crossover we've seen 5 times in the last 6 or 7 years, and each time preceded the price going up. So that's another thing I've been looking at.
Yeah, Mitch, I think that was fantastic on-chain and derivatives analysis. One thing that you mentioned that really stuck out to me, I think is very important, is you talked about Bitcoin's extreme volatility. I think a lot of people forget that just, I guess 4 or 5 years ago, Bitcoin was sitting around in late 2018, early 2019, just sitting around $3,000 per Bitcoin. Now, a lot of people in the mainstream world think, hey, Bitcoin is dead. It's sitting at $22,000, when in reality, that's, over 7x increase in the price of Bitcoin. I mean, I don't know how long you would have had to go back looking at, S&P 500 returns in particular to get a 7x increase, even if you include, dividend payouts. And so I think during the monetization phase of Bitcoin, which obviously we've been in for over a decade now, it just more clearly highlights, the importance of, hey, Bitcoin is going to be extremely volatile, but with this volatility, the returns that you're going to get by holding Bitcoin, or at least historically have gotten by holding Bitcoin, way outweigh the amount of short-term volatility that you experience. And so yeah, I think you made a fantastic point that, hey, Bitcoin's volatility is here, it's still here, but volatility is the price you pay for returns.
100%, Joe. That's spot on. And something that kind of makes me laugh is you see people, they compare the cycle top of 2017 to where we're at now, and they're like, oh, look, Bitcoin's, how's it a long-term store of value? It's been 5-6 years and it's still where it was, but it really only spent a day at 20,000, and then it came crashing back down. So judging from where we're at in this cycle to where we're at in past cycles is definitely the way to compare Bitcoin over time. And I just pinned in the nest, the halving epochs. So you can look and see where we're basically, according to past halvings, we're at the bottom. So, definitely don't take one metric as like the end all be all. But when you look at, on chain as a whole, a lot of things are pointing to the fact that we are towards the bottom of the bear market.
Yeah, I definitely think you're right, especially from an on-chain perspective. I do have one last question before we transition to mining, and you kind of touched on this a little bit, but you talked about how there was a massive nominal amount of long liquidations last night, and kind of Blake touched on it a little bit as well. But the Bitcoin price has really held up pretty well despite seeing like that number of long liquidations. I guess, why do you think that's the case? And do you maybe think that that's a bullish sign that, hey, there was a lot of forced selling, but the price didn't really go down that much?
Yeah, I think that's it, right? Nobody wants to sell Bitcoin at 20,000. The only people who are selling are those that were foolish enough to lever up and got margin called and had to sell. So it's definitely there. There are no I think all the capitulation, all the panic is already out of the market. Bitcoin specifically, that happened with the Celsius and FTX. So now anybody selling here is just going to be a forced seller. So avoid levering up, and we shouldn't have these wicked price wicks. 5% in an hour.
Yep, sounds good. That makes sense. I'll transition to mining, and then I'll probably make this a little bit shorter than normal because I know we do want to cover the Mining 101 report that Mitch you led. So I'll transition this to mining real quick. There were three topics this week in the newsletter related to mining. The first one that I put in, and I'm going to pin it to the nest, but basically is a table highlighting the break-even price for various Bitcoin ASICs operating at various energy rates. And so I'm trying to find it. Oh, here's the tweet. So the idea is, okay, you're a Bitcoin miner. You're competing against all other Bitcoin miners on the Bitcoin network. You need to kind of figure out, okay, where are you in the landscape of the Bitcoin mining industry? And this depends on really two key factors. It's how much are you paying for energy? And then it's also what model ASIC are you running? And this table that's pinned to the nest is just highlighting Bitmain ASICs because that's the most popular manufacturer, but you could find the what's miner equivalent ASIC and kind of highlight it or put it in this table as well. But the key point of this is kind of showing, okay, if you know what your competitors are, like if they're running S19 XPs or if they're running S17s or S9s, you can see, okay, which miners are going to feel more pain before you. And you're going to be able to know, okay, if the price of Bitcoin falls to a certain level, it's likely that other miners or certain miners on this table will turn off their mining rigs before you turn off your mining rigs. And because of the way Bitcoin works, i.e., the difficulty adjustment, when miners turn off their rigs, that means if you're a surviving miner, you're going to be mining more Bitcoin because difficulty will fall. And so the most efficient miners on the network kind of have this like downside protection hedge just natively built into Bitcoin. And it's because if a large amount or even a small amount of miners get knocked off the network for profitability reasons or unprofitability reasons, you're going to be still in the network earning more Bitcoin, which might be less dollars, but you're going to be earning more Bitcoin to kind of offset those miners that have dropped off the network. So I think it's a really important table that miners should be, very aware of to get a sense of, hey, where am I on the network relative to other miners on the network? The second topic that we covered in the newsletter was hash ribbons. And so hash ribbons is a metric that kind of shows when are miners net capitulating on the network, which basically means when are miners on net turning off their machines. And it doesn't happen often because, we're miners are kind of always plugging in new, more efficient machines, and older less efficient machines are slowly always coming off the network, or if you have high energy prices, you're slowly getting weeded off the network. But when these minor capitulations do occur, it's typically a sign that the network is under extreme stress at the moment, and Bitcoin is likely in the process of bottoming. And so we saw this at the end of 2018. We saw it in March 2020. We saw it during the China mining ban. We saw it around the FTX collapse, and then we saw it at the end of 2022 as well. And so the reason we put in the newsletter this week is just kind of highlighting that, hey, we've talked about this before. We've shown that, historically when miners do capitulate, it's very likely that, Bitcoin is in the process of bottoming. And so far, it kind of seems to be the case, looking back on the minor capitulations we had in mid 2022 and late 2022. The very last topic that I just wanted to quickly discuss is Bitcoin energy gravity. And so the idea behind energy gravity is it's trying to show, okay, when are miners, just printing money, and then when are miners just struggling to get by? And so energy gravity shows the estimated, electricity rate break even price for a modern Bitcoin ASIC. And the idea is, hey, if a modern Bitcoin ASIC is willing to pay 1 cent per kilowatt hour for energy, and it would still make money, which is a lot of, for reference, like your retail energy rate might be 20 cents per kilowatt hour or 15 cents per kilowatt hour. And so if Bitcoin ASICs are willing to outbid, your use of electricity, it's probably a sign that the price of Bitcoin is temporarily overheated. But on the other hand, if the most efficient ASICs on the market are just kind of squeaking by and their profitability levels are relatively low, it's probably a sign that, hey, the mining industry is is struggling to get by at the moment, and it kind of means that the price of Bitcoin could start moving up, or at least be in the process of bottoming. And so the chart in the newsletter showing energy gravity kind of shows, hey, 2021 and early 2022 price of Bitcoin was clearly overextended. The cost of production for Bitcoin miners was significantly below the actual price of Bitcoin. And now we're kind of in a regime where the price of Bitcoin is actually fairly close to the cost of production. And so there's kind of room for the price of Bitcoin to run some, and then the mining industry will respond after that and deploy a lot of hash rate. And then that would bring up difficulty, and those profits would eventually be captured. But in short, I think energy gravity is just another metric that shows Bitcoin is likely in the process of bottoming.
Joe, I've got an idea here on energy gravity. It sort of ties in, right? So my thesis, and I think a lot of people here, is that the price of Bitcoin's going to go up, right? It's going to go up over time. And what you're seeing is on exchanges is the balance on exchanges continues to go down. And right now there's about 1.7 million Bitcoin left to be mined, and about 2.2 million left on exchanges. And what I believe is the exchange balance is one day is going to go less than the amount available to mine. So I think, and this sort of ties into Jason Lowry's thesis, nation states or even just large institutions that want to have exposure to Bitcoin, I think mining is going to be really the only valid route there, because the long-term holders, if they keep accumulating a large percentage of the supply that's already circulating, they're not going to sell it. So really the only way for them to get their hands on Bitcoin is going to be to mine.
Yeah, I definitely agree there. I think Jason Lowry probably has a similar thesis, and he kind of calls it the hash wars. But yeah, I definitely agree. I think if the price of Bitcoin soared, significantly in a short period of time, whether it's because people lose trust in, traditional financial assets, or people are just simply like, hey, this is the best money humans have ever discovered. It's perfectly scarce. It's portable. It's durable. It's divisible. We need to accumulate this and store it, and save it. The price of Bitcoin can soar, but mining difficulty really can't soar that much, or that quickly, because you got to build out massive amounts of energy infrastructure and massive mining infrastructure and mining rigs and all of that. And that takes time. So yeah, I definitely think there's if the price of Bitcoin soars, there's going to be a massive arbitrage opportunity in the mining industry, and there's just going to be a lack of actual Bitcoin to buy on exchanges. And the best way to accumulate Bitcoin when the price of Bitcoin is soaring is likely going to be mining, especially at a large scale for nation state level.
And I guess you could even consider it on a smaller scale, right? Because some people tend to believe that they might cut off the on ramps, but they can't really stop you from mining if you have some sort of if you have cheap access to cheap power and you want to run a mining rig. There's nothing that can really stop you there. So mining is probably going to be the most important way to accumulate Bitcoin in the future. And so it certainly wasn't in the beginning, right? Because there wasn't a whole lot of liquidity in the market. Buying a ton of Bitcoin wasn't exactly as easy as it is today. So I guess we're sort of in this middle range where, hey, you can really trade your dollars for Bitcoin conveniently and with nearly any amount, right? Obviously, you couldn't buy $1 trillion worth. That would push the price up. But I guess we're sort of in this middle stage where, hey, early on in Bitcoin, mining's the best way to accumulate it, and then now we're definitely shifting towards, again, hey, mining is the best way to accumulate it.
Yeah, I mean, Bitcoin ASICs directly convert energy into immutable scarcity, right? They convert energy into Bitcoin. And, whether it's dollars, yen, euros, or Venezuelan bolivars, at the end of the day, those are just, pieces of paper, as Luke Broyles calls them, political currency units that kind of their value can shift at the whim of a small group of people, whether it's a central bank or the government itself. And so Bitcoin, with actual real energy, bounded by real energy, like that's a real physical cost that exists in the real world. It's not some, I guess, abstract, value that, nation states or central banks kind of, create out of nothing. With energy, it's real and it's physical and it exists. And so yeah, I definitely agree. Like, political currency units or dollars or bolivars or yen could get very abundant, even more abundant than it is today, whereas actual energy is very scarce, or is at least more difficult to produce than some sort of piece of paper currency.
Awesome. With that, we can jump to the last topic of the space, which is the Mining 101 report that we just put out. Let me pin it up in the nest real quick. But we co-published and co-branded this report with the Satoshi Action Fund, Dennis Porter's nonprofit. And the idea here, this report isn't any groundbreaking research like some stuff we've done in the past. There's no new metrics here, but this is purely from trying to educate people on Bitcoin from the ground up, right? The Satoshi Action Funds, their goal is to educate policymakers and regulators on Bitcoin. So we built this report, this deck to assist with that. So if you're curious as to what type of information are regulators going to be getting on Bitcoin, this is something to look at, and this will be shared with people Dennis comes across in his work. And basically, yeah, it's mining 101. So if you go through this thread, it literally works from the ground up. So starting with very simply, what is it? What is a node? What is a miner? Who's using Bitcoin? What's proof of work? What is a valid block? What even is a blockchain? We discussed hash rate. We discussed the block subsidy, difficulty, all these things that they may seem easy and very elementary to us and anybody who's been in Bitcoin for a while. But if you really go out and you talk to a lot of people in the world, they simply have no idea. Like, all of this is just a foreign language to them, and education really is the most important thing, right? I understand there's a certain argument, Bitcoin wins regardless, right? Number go up is going to cause mass adoption. But if you can educate, policymakers and regulators and not have them make your life difficult, not have hostile legislation to proof of work or Bitcoin on ramps, that's certainly going to make the world a lot better of a place. It's going to make breaching that threshold of mass Bitcoin adoption a lot easier if you're not having politicians set up roadblocks. So, getting people in office that are understanding why Bitcoin's so valuable, why, because a lot of people, I think their first instinct when people try to orange pill them, quote unquote, is like, oh, they just want me to buy their Bitcoin at a higher bag price or whatever. That's not the case at all. We genuinely believe that Bitcoin's going to make the world a better place. So that's why we want to educate people. And if more people can learn what sound money can do for the economy and what Bitcoin mining can do for energy grids, that's going to make this process a lot easier. And towards the end of the report, we start talking about, what is the mining business model? Why are people mining? And what can Bitcoin mining do for the energy grids? Because it's something that's I don't think it's intuitive to a lot of people. When you hear, Bitcoin mining balances energy grids, a lot of people, they don't really, and this is how I was at first. It just doesn't make sense, right? Oh, they're consuming a lot of energy. How does that work? But when you think about it, you have to the grids have to scale, right? You have to build and be able to produce energy. And if there's nobody to buy it, there's no incentive to build the grids out. Whether you subscribe to the ESG belief or not, if you want renewable power, it's fairly unreliable. But having Bitcoin miners there as a buyer of last resort, there's an incentive to build that out. And Bitcoin miners, they essentially function as a battery, right? When there's excess power being produced, they buy it. But when there's high demand during the dead of winter, the heat of summer, they're willing to turn off. Not only, well, there's two reasons, right? First is they often sign it in their contracts, like, hey, if demand reaches a certain point, we'll turn off. But also they're financially incentivized to do it, right? Because if there's a lot of demand for power, the price of electricity is going to go up. Bitcoin miners are going to be unprofitable. It doesn't make sense for them to run their machines. So it really is the perfect match for energy grids. And not to mention the whole natural gas flaring situation, which we put in this report as well. The White House estimates that mining emits 154 million tons of CO2 annually, which is more than is 144 billion cubic meters flared annually. So if you do the math there's a chance for Bitcoin mining to actually be a net negative on CO2 emissions, right? Because if you take out the flaring, the nat gas emissions that are saved by not having to flare gas, that actually offsets the entire carbon emissions of all the other Bitcoin mining. Which, whether or not you think carbon emissions are a problem, it doesn't really matter, right? Because a lot of people in politics who are going to be making this regulations and stuff, they do view it as a problem. So being able to educate that, like, hey, even if you do think this is a problem, Bitcoin mining actually solves that. So that was the premise behind making this report. I think it's very easy to digest. Before publishing it, we all shared it with people we know that really don't have any background in Bitcoin, and they were able to look through and definitely learn. There's a glossary of terms at the end to make things even easier. So definitely, I think this is a very valuable tool if someone asks you, hey, tell me about Bitcoin, tell me about mining, right? You don't want to answer everyone's question individually, especially when the next bull run comes. I'm sure everyone here is going to be getting a lot of people that in real life asking you about Bitcoin. So sending them this slide deck, I think, is an easy way to just have a tool for them to flip through, and then if they have questions, they can ask you after.
Yeah, Mitch, that was great. It's funny because I'm really excited about releasing this report, and like you mentioned, it's not groundbreaking research by any means, and most of what Blockware Intelligence releases is geared towards the seasoned Bitcoiner, and this is kind of towards the noob, if you will. You're trying to it's being used to orange pill representatives and policymakers, and I think it's really cool, and it makes a really really easy tool to send to someone to orange pill your friends and family, like you were mentioning. I think even as I would imagine most people who are in this space are already fairly knowledgeable about Bitcoin, right? If you're following any of us or you follow Blockware, but I think there is still some value to be had from reading this report as someone who already knows what a blockchain is and already knows what proof of work is, and it's the energy stuff that you were just talking about, Mitch. And I think the most exciting thing to me about mining in the future of mining is, and I think, well, potentially what the future of mining is a lot of the natural gas flaring stuff that you just talked about. So it enables miners to run for get electricity for pennies on the dollar, and potentially have a positive impact on the environment. I also think the energy grid stuff is really interesting, and I think kind of the easiest way to explain it is that energy grids are going to be or just energy pricing in general, is best for all when there's a flat demand curve. So when there's a constant level of demand for energy, it enables energy producers to scale up grids, and it's going to lower the price of energy for all. The issue is that doesn't happen in the real world, obviously, right? You're going to use a lot more energy in July and it's 100 degrees out versus when it's April and it's 60 degrees out. But Bitcoin miners can come on grids and they fill that void. And the interesting thing is like this is already happening. So it's like the methane gas flaring and the balancing of energy grids and demand response programs and all this stuff. It isn't theoretical. This is how Bitcoin mining actually works in the real world. And I like that's the coolest part to me is a lot of people talk about the carbon emissions of Bitcoin mining and the negative impacts that Bitcoin mining has and this and that. But I think generally speaking, those kind of exist in the realm of hypothetical, if you will, because when you look at the real world and you look at the relationships that miners actually have with energy producers, it's a lot more of a complex relationship, and you see that it actually, for the most part, becomes a win-win for the miners, for the energy producers, and for everybody who uses the grid, whether they know it or not.
Yeah, guys, I think that was both really well said. I highly encourage anyone or everyone to check out this report, check out the thread that Mitch pinned above. I think it's great. Mitch, do you have any other thoughts? I know you're about to say something.
No. I mean, I think we've hit on all the key ideas here. One thing that I don't see, I guess it sort of got swept under the rug, but Shell sponsoring the Bitcoin 2023 conference. I think people hear that and it's like, oh, that's cool, but like that is a giant energy and oil company, a global brand. Shell, like they're on just about every corner in my area. So seeing a huge energy giant get into Bitcoin mining, honestly, it's pretty early too, right? Bitcoin's only about 14 years old, and we've already got a massive energy company. I think in the future, every energy company is going to be a Bitcoin mining company. And honestly, if I was the CEO of an energy company, I would be foaming at the mouth right now with how cheap some of these mining stocks are, right? I think it just makes sense for some of the energy companies to acquire these Bitcoin mining companies, or at least partner with them.
Yeah, and not to mention that ExxonMobil's already doing it, right? They have a facility out in North Dakota, I believe, where they've been mining bitcoins for a couple years now. So it's really cool to see that like it's actually happening. This isn't something that we're hoping is going to happen in the future. It's already well underway.
Absolutely, and this can be used to educate those oil executives too, right? Not just politicians and not just your high net worth individuals. So really, there's a lot of use cases for this report, and I'm glad we put this together. If you guys have any more comments before we close up, now's your chance.
I don't have really anything, any closing comments. Just wanted to thank everyone for listening. Be sure to go check out the report and have a great weekend.
Yeah, thanks everybody for listening. Check out the report, check out our podcast, check out our newsletter. I think it's all pinned in the thread, and follow Blake, Mitch, Blockware, and feel free to DM us if you have any questions relating to Bitcoin, macro, or mining.
Absolutely, DMs are always open. I love to talk about this stuff. Thank you, everybody.